Okay, so you're working maybe 60 hours a week, maybe more, 7 days sometimes. You're careful, you save every dime, you don't splurge, really disciplined. But here's the big question we're digging into today. Those financial habits, the ones that made perfect sense back in Vietnam, cash is king, avoid debt at all costs. Could they actually be, well, costing you money here in the US, making things harder?
Yeah, that's the core tension, isn't it? You've got this culture built around safety, cash, avoiding banks sometimes, clashing with the U.S. system, which is, built on credit and debt. And it's not about people doing things wrong. Our sources show that. Like 83% see saving as absolutely fundamental. It's just the rules here are completely different. That gap is the real issue.
Exactly. So our goal today is simple. Let's cut through the confusion. We want to unpack the 5 biggest money traps we see hitting new Vietnamese immigrants. And these aren't small oopsies. These can cost, tens of thousands in lost growth, higher interest payments, nasty fees. We want to give you practical steps right now to bridge that gap.
And you have to understand the background, right? Years of instability back home meant trusting cash, maybe gold, things you could hold. Not necessarily banks. Having savings meant you were secure. But here, that same instinct, wanting everything in cash, kind of makes you invisible to the financial system. It actually works against you because they can't measure your reliability.
Okay, let's jump into the first big one. It seems counterintuitive, maybe. The credit ghost thing, I can hear listeners thinking, hold on, I don't owe anyone anything. I've got $50,000 saved up. How am I at a disadvantage? What are they missing there?
They're missing how trust is measured here. It's less about the cash you have and more about, well, data, your history of borrowing and paying back. If you completely avoid credit, the system, the algorithms like FICO, they have nothing to go on. You're basically invisible. A credit ghost. And having no credit history. It's almost as problematic as having bad credit history because banks, landlords, lenders, they just can't figure out if you're a safe bet or not.
And that invisibility costs real dollars, doesn't it? It's not just a number.
Oh, absolutely. Big time. You go for a car loan. Forget that nice 4% rate you see advertised. You might get hit with like 15%.
15%?
Wow. And that difference, thousands of dollars extra over the loan term, or renting an apartment. Landlords might demand 2, even 3 months rent up front as a deposit instead of just 1 because they see you as a higher risk.
Ouch. Okay, so what's the fix? It sounds like a deep hole.
The fix is actually pretty straightforward, but it means getting over that mental block about borrowing, even a little. You need to start building a history. The safest way in, a secured credit card. It's low risk. You give the bank some cash as collateral, say $500, and they give you a credit card with a $500 limit. It works just like a normal card.
Okay.
So you use it for small things, gas, groceries, pay the entire balance off every single month. Every time. The key thing is the bank reports this good behavior to the credit bureaus. Equifax, TransUnion, Experian. Suddenly you're not a ghost anymore. You're building that financial passport.
So just changing how you pay for everyday stuff starts building that trust score. Okay, that makes sense. But, all right, let's say you fix the credit invisibility. There's still that pile of cash maybe sitting in a checking account, or worse, at home. That brings us to the second trap, inflation, the silent thief.
Exactly. That habit of keeping a lot of dead money around, cash in a drawer or in a checking account, earning basically zero interest. Culturally, that feels like the ultimate safety, right? But in the U.S. economy, it's like a slow leak in your savings bucket. People sometimes mix up saving, which is just capital preservation, keeping what you have with investing, which is asset growth, making your money grow. If your money isn't growing at least as fast as inflation, then, well, its buying power is shrinking every single day. You're losing money while you sleep.
And it's not trivial. We looked at the numbers from our sources. Let's say you have $50,000 sitting totally still for 10 years. With typical inflation, poof, you lose something like $13,000 in actual purchasing power.
$13,000 gone, just because it sat there?
Yeah. It feels like you're being responsible and saving, but inflation is like this hidden tax just eating away at it. That number alone should make anyone rethink stashing cash under the mattress.
Right. So 2 concrete actions here to fight back. First, your emergency fund. You still need that safety net, maybe 3 to 6 months of living expenses, but don't keep it in cash or a standard checking account. Move it immediately into a high-yield savings account, HYSI.
HYSI, okay.
These are usual online banks. They offer much better interest rates than traditional banks, and they're still safe, FDIC insured, up to $250,000, just like a regular bank. So safety plus some inflation protection.
That handles the emergency cash, but what about money beyond that? For actual growth?
For money you don't need short-term, you got to put it to work. You need to harness compound interest. That's the real engine of wealth building here. And look, you don't need to become a stock market genius overnight. That's way too risky for most people starting out. Keep it simple. Start with low-cost index funds. A really common one is an S&P 500 ETF.
S&P 500. So you're basically investing in, what, the 500 biggest U.S. companies?
Pretty much. You're betting on the overall success of the American economy. Historically, that's been a very solid bet for long-term growth. Low fees, diversified, much safer than picking individual stocks.
Okay, moving on. Mistake number 3, this one. It just feels painful because it's like actively refusing a raise. We're talking about skipping the 401k match, refusing free money.
Oh, this is probably the single biggest immediate financial blunder we see.
Yeah.
You get a job, the company says, hey, if you put money into your 401k retirement plan, we'll match it. Often it's dollar for dollar, maybe up to 3% or 5% of your salary. That's an instant 100% return on your money. Risk-free.
A guaranteed 100% return. You can't get that anywhere else.
Nowhere. But people avoid it. Maybe the paperwork seems confusing, or they think, I want my money now in my hand where I can control it. By doing that, you are literally walking away from thousands of dollars a year that the company wants to give you. It's part of your total compensation package.
It sounds like a no-brainer, but there's a catch, right?
Especially for newcomers.
We found sources talking about the 401k match is a TRAP angle. What's that about?
Ah, yes. The catch has a name. Vesting. It's crucial to understand this. Companies don't just hand over that matched money for you to keep immediately. They want you to stick around.
Okay.
So most have a vesting schedule. It might take, say, 2 years, maybe even 5 years of working there before you fully own 100% of the money they contributed. If you leave before you're fully vested, poof, you could lose some or even all of that free matching money.
Right. And that's a huge risk for someone who might be on a temporary visa or needs to change jobs quickly to get sponsorship or just finds a better opportunity. Job mobility is high for many newcomers.
Exactly. So if you quit after 1 year and the vesting schedule is 3 years, you might walk away with none of the company match. It feels like a trap then.
So given that risk, does it ever make sense to maybe skip the match and instead put money into something you own right away, like a Roth IRA, even though you lose the match? It's a trade-off between free money and immediate ownership, isn't it?
That's a really sharp point. It highlights the complexity. For pure absolute certainty of ownership, yeah, an IRA you control instantly feels safer. However, that employer match is just so valuable to 100% return. You really can't beat that anywhere reliably. So the advice usually isn't to avoid the 401k. It's always contribute at least enough to get the full company match. Don't leave that on the table.
Worth the match,
but take 1 hour seriously, just 1 hour to find out your company's specific vesting schedule. Is it 2 years? 5 years? Graded vesting where you get a percentage each year. Know the rules for your job. Understand your exit risk. If you know you might leave in 18 months and vesting takes 2 years, factor that in. Maybe staying those extra 6 months is worth thousands in free money. Knowledge is definitely power here.
All right, let's shift gears now. Let's talk about community finance. Mistake number 4, relying too heavily on informal money groups like Cho Hu. Back in Vietnam, these are really common, right? A way for people in a community to pool money and get access to capital quickly without dealing with banks, built on trust.
Exactly. Very practical in that context. But here in the U.S., that system, because it's based purely on trust and isn't regulated, it becomes incredibly risky.
How so? What's the big danger?
The danger is there's zero legal protection. It operates completely outside the U.S. financial and legal system. So when things go wrong, and they sometimes do, like the leader of the WHO vanishes with the money, or the whole thing just collapses because someone defaults.
Right.
There's no FDIC insurance, no legal contract you can enforce easily. You can lose everything.
Yeah.
We've seen stories where people lost their entire life savings, money for house down payment, gone overnight.
Yeah.
And relationships ruined too.
Devastating. And yet, we need to acknowledge why they exist here too, right? Sometimes the formal banking system feels inaccessible, especially if you don't have an SSN yet or that credit history we talked about.
Absolutely. It fills a gap left by the formal system. So we're not just saying don't do it. We're saying there might be a safer legal alternative that serves a similar purpose.
Like what?
Look into lending circles. These are often run by nonprofit organizations. They work similarly. A group pools money, members take turns borrowing. But here's the key difference. They are structured legally, and crucially, they often report your payments to the credit bureaus.
Ah, so it helps build credit.
Exactly. You get the community saving aspect, but it's safe, regulated, and it helps you build that credit history. You need to access mortgages, loans, everything else in the formal U.S. system.
Yeah.
It turns a potential risk into a credit-building opportunity.
That's a fantastic alternative. Okay, finally, mistake number 5. This one is about active threats. Vulnerability to scams, especially affinity fraud and government impersonation.
Yes, this is sadly very common. Scammers specifically target immigrant communities. They know how to build trust, sometimes using that phrase, "Dom Hung Jup Nao Lam Jiao," fellow countrymen helping each other get rich. It's manipulative.
What kinds of scams should people be most aware of?
2 main types keep popping up. First, the fake government agent call. Someone calls claiming to be from the IRS or maybe USCIS, immigration. They sound official, maybe even have some of your information. They say you owe money or there's a problem with your papers. And if you don't pay right now, you'll be arrested or deported. They use intense fear tactics.
That sounds terrifying. How do they demand the payment? That's the tell, right?
That's the biggest red flag. They always demand payment in ways that are fast and basically untraceable. They'll say, go buy $500 in Target gift cards and read me the numbers. Or send money via Zelle to this account immediately. Or wire transfer, or even cryptocurrency.
Let's be crystal clear on this.
Absolutely. The real U.S. government, the IRS, USCIS, any one official will never ever call you and demand immediate payment over the phone using gift cards, Zelle, or crypto. Never. They communicate primarily through official mail.
So if you get that kind of call,
Hang up. Immediately. Don't argue, don't engage, just hang up. Then, if you're worried, find the official number for the agency online. Don't use the number the caller gave you, and call them directly, and report the scam call.
okay, hang up and report. What about the other type? The investment scams.
Those prey on the desire to get ahead financially, maybe feel like you're falling behind. Scammers promise outrageous returns. Invest in this amazing crypto opportunity, guaranteed 20% return per month, or some vague real estate deal promising impossible profit.
It's 20% a month. Yeah, right.
Exactly. If it sounds way too good to be true, it 100% is a scam. Legitimate investments don't guarantee massive, quick returns like that. They're just trying to get your money and run.
So the action step here is healthy skepticism.
Deep skepticism, especially if it involves high pressure, secrecy, or promises that defy basic math. And again, report any suspicious investment schemes. The FTC website, reportfraud.ftc.gov, is the place to go. Hashtag tag outro.
Wow. Okay, so let's kind of wrap this up. We've covered a lot of ground. The big takeaway seems to be your cultural values, hard work, saving, being careful. Those are amazing strengths. But the U.S. financial system just operates on, well, different rules. You have to make some tactical adjustments.
That's the core of it. It's moving from that survival mode thinking where cash is everything and debt is terrifying to more of growth mode thinking. Understanding that here, credit isn't necessarily bad. It's a tool you need to access better opportunities like lower interest rates on a mortgage, better insurance premiums. It's not a moral issue. It's just how this particular game's played.
That shift in mindset, really understanding how credit and inflation work here, that feels like the crucial $50,000 lesson, doesn't it? Avoiding those hidden costs.
It really is. Mastering those basics unlocks so much potential.
So if this deep dive helped you spot a costly habit or maybe understand a risk you weren't aware of, please share this with someone you know, maybe someone who just arrived or is planning to move here. We talked about these 5 big traps, but learning is a community effort, right? We really want to hear from you. What was your toughest financial challenge or biggest aha moment when you first started navigating the U.S. system? Let us know in the comments below. Share your story, share your strategies. Let's help each other out.
Definitely. And today we really focused on getting the foundations right, that initial survival and stability phase. Next time, we want to talk about leveling up, moving beyond just surviving and saving and into actually building lasting, maybe even generational wealth.
Ooh, okay. So beyond the 401k.
Yeah, thinking strategically about things like real estate, diversifying investments beyond just the S&P 500, making sure your money is really working as hard for you as you work for it, shifting fully into that investment mindset.
Sounds like a great next step. All right, don't miss that next deep dive into financial growth.